Welcome back, Adam here. Today I want to share with you a clip that I was watching over the weekend, and I want to give a little bit of narrative on this. This is Dan Ives. He's a Wedbush analyst, and he was talking to CNBC, suggesting that there are generational buying opportunities in the market right now, selective generational buying opportunities, but opportunities nonetheless. So I want to take a look at that and give my thoughts on this one.
Welcome the Wedbush analyst to Post 9 to make his case. You really think this is a generational buying opportunity?
Well, I think for the right stocks, but because our viewpoint covering tech since late 99, in these downturns, you got to separate the froth from what we believe are the names that are going to be able to navigate and valuations that we believe are way oversold. So I look at software, cybersecurity. I look at names like Microsoft. You look at names like Amazon, Apple, among others.
So mainly mega cap tech he's talking about.
That's why to us, we're not just going to sit here and say you paint them all with the same brush. It's a bifurcated tape.
Okay, let's talk about the mega caps specifically, because who's to say that these stocks deserved to be where they were before this recent sell-off?
That's a fair point to make.
I take a look, and I raised this issue, and I asked our team to put these numbers together because I wanted to raise this with you. If you look at where the PEs were for all of the mega cap all-stars, right? From the pandemic low, let's call that March 2020, okay? Apple's PE was 17.
Okay, I'm going to stop it there before he really gets into this, because I think that's a fair point to make. Who's to say the valuations were meant to get to where they got to, or is fair valuations when they hit them? But what I don't like is this comparison that they give here. Now, obviously, they're pushing a narrative. They've got a story to sell, so you don't expect them to be completely impartial. But there's enough negativity in the market already, and it seems like they're just trying to push that at the moment, because the narrative that they're trying to push here is that valuations spiraled out of control and detached from the fundamentals. And they're doing that by showing you the March 2020 pandemic low price to earnings ratios. And they're comparing them with the January 2022 all-time highs. Okay, and they're right to look at the all-time highs, these January 2022 PEs, but why are you comparing back to March 2020? Why are you comparing back to one of the most uncertain times in stock market history, when global economies were shut down? Why would you ever compare back to those? It would be much more sensible and a better comparative to compare back to, say, pre-pandemic 2019 PEs, which is exactly what I'll do in a second. Let's just hear them out before we actually look at those PEs.
All-time high S&P, it got up to 30. Microsoft 23 got to 34. Alphabet 22 got to 25. Meta from 18 to 24. Nvidia from 27 to 58. The point being that a lot of these...
Now, I'm definitely not suggesting that these valuations in January 2022 weren't out of control. The valuations were getting a bit stretched then, but I am saying that we shouldn't be comparing and looking back to March 2020 with all that uncertainty in the market. And if we actually replace these figures with a better comparative, say 2019 PEs, it would look like a slightly different picture. So let's do that now. So they're giving you a comparative of 17 for Apple, a PE of 17. But if you head to Morningstar.com is good for this. You can pump in the name of the company and then look at historic valuations. The PE for Apple in 2019, pre-pandemic, in more of a normalized trading environment, was 24.7. And they're giving you a comparative of 17. Okay, so it doesn't look quite as bad there. The PE they're giving you for Microsoft is 23. If we look back to 2019 for Microsoft, 29.75. 29.75 against 34 isn't quite the same picture. Alphabet, they're suggesting a sensible PE is 22, but if we look back to a 2019 PE for Alphabet, 28.75. Now, the thing with Alphabet, 28.75 in 2019, even at all-time highs in January 2022, the PE was only 25, okay? 28.75 in 2019, 25 at all-time highs in 2022. So relatively speaking, if you were buying, even at those all-time highs, you were buying the stock cheaper relatively compared to buying in, say, 2019. Amazon, they want you to compare to 58. If we look at Amazon in 2019, 81.87, and it's going to be a similar story with Meta. So they're giving you a comparative of 18. If we look at Meta in 2019, it was 32. So I know Meta has really sold off recently, but even if you're looking at the all-time highs, even in January 2022 at all-time highs, Meta, relatively speaking, was cheaper than it was in 2019, which is crazy to me. Now, I'm not suggesting that the market didn't get carried away and valuations get stretched at this point here. I'm also not suggesting that 2019 is a perfect comparison to make, but it's certainly better than March 2020. The problem at the moment is we're in a very different market to any of those points in time. We have the after effects of COVID. We have rising inflation that's really out of control, rising rate environment as well. And we also have war in Europe. So it's a very different environment to compare back to, but I definitely think that they're overdoing it by using these March 2020 comparisons.
Stocks, if not the whole group, got that burst because of all that the Fed was doing from liquidity, right? Now that the Fed's pulling that liquidity away, why shouldn't these stocks go back to where they were around the time that the Fed injected this liquidity? These stocks didn't run up in the manner in which they did on fundamentals, did they?
Surely, if you're looking at the PEs and they were cheaper at all-time highs than they were pre-pandemic, then surely that answers your question. They did actually run up on the fundamentals because even at all-time highs, they're cheaper to buy than prior. So I think that's a poor argument to make.
And that's a great question. That would be a big debate. And
I don't know why he hasn't called him out on that, actually.
I just view it as fundamentally, when I look at the trends over the next, call it 2-3 years, when I look at the cloud trends, I look at semis, I look at AI, I look at what I believe is the fourth industrial revolution. You stress test these numbers. Look, this is the fundamentally different. The buy side, they're already looking now, 2023 numbers, assume mild recession ahead of the sell side. So my point is that numbers here.
Okay, so we got some more current data to look at here. I've taken a screenshot of the comparatives that they were using. So these are forward Ps on the right-hand side. So not exactly, not ideal for the comparative, but it gives you an idea. So Meta Platforms, a few days out of date now, but forward P of 16.84. That's cheaper than in March 2020. With all that uncertainty in the market, that's unbelievable. It's cheaper to buy Meta Platforms now than it was in March 2020. I can't get my head around that. Amazon with a forward PE of 67. Now, Amazon's a little bit different because if you think about Amazon, their guidance recently was horrible. So I think the next quarter or two, or even beyond that, supply chain issues are really impacting the bottom line for them. So in fact, they came in at a loss this quarter, didn't they? So the forward PE here is going to look slightly elevated, but even if you compare back to March 2020 levels, I think we'd actually, if you adjusted for that, we'd probably be closer to this 58 figure than it's actually suggesting there. Now, Netflix at 18.37, they didn't have in their original charts, but if we go and look at Netflix in 2019, Netflix was trading at a PE of 103 in 2019. And of course, we've seen slowing user growth for Netflix, but to see it trading at 18 does look like a real opportunity, and I have added to this in my portfolio quite heavily recently. And then finally, Alphabet at the bottom. If I just bring this back on screen here, Alphabet with a forward PE at the moment of around 20.5. Looking back to March 2020, it's 10% or so cheaper than March 2020 levels, and again, doesn't make any sense to me. Let's carry on.
Relative. I mean, if you look at MFANG from an EBITDA perspective, I mean, 12 times, you're starting to look toward what I go almost be market multiples for what I view as probably the best growth names across tech.
But say, like, these stocks were used as, in some respects, bond proxies. In, I think, a large respect, defensive plays in an uncertain world during the pandemic. Can you make the argument to me today that Apple deserves to be at a 30 PE? or does it deserve to be closer to the 17 where it was before the Fed?
But again, 17 was in the height of the pandemic with all that uncertainty. So it's not really a great comparative to make, and certainly doesn't deserve to be at those levels.
Put all of the punch in the bowl.
Okay, so that's a good example. Let's just look at Apple.
Yeah.
The services business is a different business today, and I believe going forward, than it was 2 years ago. So you're talking about an $80 billion revenue stream that basically has been a big part of the re-rating in Apple. And it's always been my contention, Apple's a name. When you look at it straight PE, instead of sum of the parts in terms of looking at services and hardware, you ultimately, what I believe is, undershoot what should be the core valuation. So my point here is that I'm not saying the froth, the web vans, the global crossings, what we saw in 2000.com front and center, that's not going to happen. I'm just saying you have to separate the have and have nots, and valuation here relative to when we go back to 08, 09 and even 01, 02 relative to growth. We view now as the time for the names that we've talked about in our tech playbook to own them.
But is Apple's services business 13 points of valuation better than it was 2 years ago?
Well, I think, and I think when you look at Apple services business, you look at the growth, you look at ultimately the margin on the services piece. I think it's something going into the pandemic, the market was basically assigned. Now it's worth $400 billion. And at one point in the pandemic, we're looking at 1.5 trillion. So I think a big difference with some of these names, I'd argue the same with Amazon. Some of the parts, what's the cloud business worth? With Google, I'd argue right here, you're assigning minimal growth and minimal valuation to the cloud. You stress test numbers on the other side of this, get every bear argument out there. But it just comes down to, like, Scott, we've talked to 25 of our checks this week, CIOs, product managers trying to understand spending.
Yeah.
Stress test these areas, it's firm. And that's why we'll cut. You'll see numbers get cut because the street will ultimately assume a mild recession.
Look, I probably wasn't quite as bullish as Dan heading into the end of last week after what had been a horrific few trading weeks. But the more you look at the fundamentals and the valuations there, the more you drill down into it, you kind of have to agree with him. It does look like a buying opportunity at the moment, and I have been buying. And it does surprise me to look at some of those valuations to see that, yes, some market caps in these mega cap names have really exploded to astonishing levels over the last couple of years. But when you look at the PEs relative to the companies, the earnings have obviously delivered in excess of that, because some of the PEs are actually lower than 2019 levels, and that really surprises me. As always, though, let me know what you think. Do you agree that we have a huge buying opportunity on our hands here, or do you think there's more pain to come? See you next time.